QQQ's 136% return crushed SPY's 87% over 3 years. But that impressive 49-point gap hides costs most investors never see coming. QQQ crushed it over 3 years with a 136% total return. That's more than doubling your money while taking the lead. But here's where it gets interesting. SPY delivered a solid 87% over 3 years, but it couldn't quite keep up with QQQ's faster tech-driven climb. In plain English, QQQ's like a sports car that left SPY in the dust, finishing 49 percentage points ahead over 3 years. Same market conditions, but tech's turbocharger made all the difference here. Now here's what really matters. QQQ's 104% return over 5 years shows strong, consistent performance when you're patient enough to hold. Here's where the story takes a turn. SPY's 98% gain over 5 years nearly caught QQQ, proving that patience can close performance gaps dramatically over time. Let's break this down further. QQQ's 21% gain over the past year shows strong momentum. Tech stocks delivered solid returns for patient investors here. But here's where it gets interesting. SPY's 18% return nearly matched QQQ's performance, showing you don't need tech concentration to win big in this market. In plain English, over 5 years, QQQ's early lead narrows considerably. Think of it like a marathon runner. QQQ sprinted ahead initially, but SPY kept steady pace over the full distance. Let's dig into the details. Returns are just one side of the coin. We need to understand the volatility each fund endured to earn those gains. Here's where things get revealing. QQQ's 1.4 Sharpe ratio means you're getting strong returns without taking wild risks. That's efficient investing right there. Now let's put this in perspective. SPY's 1.2 Sharpe ratio trails QQQ here. Decent risk-adjusted returns, but not quite matching the tech-heavy winner in this matchup. In plain English, think of the Sharpe ratio as your investment report card. QQQ earned a better grade for delivering returns per unit of risk. Both passed the test, but QQQ's efficiency scored higher overall. Here's the thing though. QQQ's 1.9 Sortino ratio shows it protects you when markets drop. That's the downside volatility that really matters to your wallet. Let's take a closer look. SPY's 1.6 Sortino ratio shows solid downside protection, but it's not quite matching QQQ's efficiency at managing those painful losses. Risk ratios look good on paper, but drawdowns reveal the actual pain you'll endure when everything's crashing around you. In plain English, the Sortino ratio is like watching a storm brew. QQQ weathers the downside better. Both markets get turbulent, but QQQ brings less severe damage when things go south. Let's see how this plays out. QQQ's deepest drop was 23%. Painful, sure, but nowhere near catastrophic for long-term investors who stayed the course. Here's what really matters. SPY's worst 3-year drawdown was 19%, 4 points less painful, which means you'd sleep better through market crashes. Now, let's connect the dots. QQQ bounced back from its worst drawdown in just 77 days. That's what we call resilience in the tech sector. Now we pause. Who's your pick? QQQ or SPY? Drop your vote below. Let's unpack this a bit. SPY bounced back in just 79 days, nearly matching QQQ's recovery speed, both showing impressive resilience after hitting those 3-year lows. In plain English, QQQ dove 4 feet deeper than SPY in this 3-year drawdown. But here's the kicker. They both climbed out of the pool in roughly the same time. Different depths, similar recovery. Now let's flip the script. A 35% crash over 5 years means watching your money melt away slowly. That's the test most investors fail. But there's a catch. SPY's worst drop was just 24%, 11 percentage points gentler than QQQ. That's the difference between sleeping soundly and panic selling. Let's get into the weeds here. 405 days just to break even. That's over a year of dead money watching your investment go nowhere. Here's where the story takes a turn. SPY took 427 days to recover, slightly longer than QQQ, even though it didn't fall as hard. Recovery time matters too. In plain English, here's the building crumbling analogy in action. QQQ dropped harder but recovered faster, while SPY fell less dramatically but took longer to rebuild its losses. Let's zoom in on this. Drawdowns reveal the worst hits you'll take, but volatility shows you the bumpy ride that actually gets you there. Let's break this down further. QQQ's 20% volatility means you're signing up for wild swings. Massive gains are possible, but so are steep drops. Here's where the story takes a turn. SPY's 15% volatility means steadier returns and calmer nights, 5 percentage points less drama than QQQ's wild swings over 3 years. In plain English, here's the roller coaster difference. QQQ swings wilder with bigger thrills and scarier drops, while SPY gives you that smooth, predictable ride. Pick your comfort level before you buckle in. Now let's put this in perspective. Over 5 years, QQQ's volatility stayed at 23%, proving this turbulence isn't a fluke. It's the new normal. Here's the classic trade-off. QQQ's 136% return crushes, SPY's 87%, but you're taking a 35% maximum drawdown versus SPY's 24%. Higher rewards, bigger risks. It's that simple. Let's dig into the details. SPY's 17% 5-year volatility makes it 6 percentage points steadier than QQQ, a significantly smoother ride for long-term investors. Here's where things get revealing. The volatility gap isn't just noise. It's baked into what these funds actually own. Let's break down why that matters. In plain English, QQQ's riding bigger waves year after year, higher highs, but steeper drops when things turn south. SPY's cruising the same market, just with way less drama along the way. But wait, there's more to this story. Fees might seem small, but they're silently killing your returns. Every dollar paid today is decades of compounding you'll never see. Here's the thing though. QQQ's fee is impressively low. Just $20 yearly per 10 grand invested makes it one of the cheapest ways in. Let's take a closer look. SPY's 0.09% expense ratio means you're only paying $9 per year on every $10,000 invested. That's incredibly cheap. In plain English, SPY's expense ratio is half of QQQ's. Seems tiny now, but like couch change accumulating in reverse. Those fees compound against you year after year, forever eating your returns. But that's not the whole picture. Fees get the headlines, but it's what's actually inside your portfolio that'll make or break your returns long term. Let's see how this plays out. QQQ puts 53% into technology. That's a massive bet on one sector, folks. You're essentially buying a tech fund here. Here's what really matters. SPY's tech allocation sits at 35%. That's 18 percentage points less concentrated than QQQ, giving you broader diversification across sectors. In plain English, QQQ's got half its money riding on tech stocks, while SPY's playing it safer by spreading the love across different sectors. It's the classic egg basket diversification play. But hold on a second. QQQ's almost completely skipping financials at just 0.31%. You're getting zero exposure to traditional banks and insurance companies here. Let's unpack this a bit. SPY dedicates 13% to financials. That's substantial exposure to banks, insurance, and lending when you buy this fund. Here's the key takeaway. QQQ's tech focus creates those wild price swings, while SPY's diversified sectors keep things steadier. That's your volatility trade-off right there. In plain English, think of it like dance partners. QQQ's doing the tango almost entirely with tech stocks, while SPY brings financial partners onto the floor to balance things out. Different moves, different risks. But there's a catch. Sector allocation's one thing, but total number of holdings shows you how concentrated your bets really are in this fund. Let's get into the weeds here. QQQ's betting everything on just 102 stocks. Pretty concentrated when you're managing billions. That's a narrow spotlight on tech giants. Now let's shift gears and look at SPY. Spreads your investment across 504 different companies. That's nearly 5 times the diversification you'd get with QQQ's holdings. In plain English, here's the pizza slice analogy. QQQ holds just 102 companies, while SPY spreads across 504. More slices means your risk isn't riding on just a few big names. Let's zoom in on this. With just 102 stocks in QQQ, one company's collapse hits your portfolio way harder than you'd think. With 504 holdings, SPY spreads your risk across hundreds of companies, so one bad apple won't spoil your whole portfolio. Here's where the story takes a turn. QQQ's tech concentration means you'll ride higher highs and deeper lows. Massive gains come with brutal drawdowns. High reward, high risk. In plain English, QQQ's like cranking the amplifier knob. You'll get louder wins when tech's soaring, but expect sharper drops when things turn south. SPY keeps everything balanced and steady. No wild volume swings either way. So here's the truth. There's no universal winner. It all comes down to your risk tolerance and investment goals. Now for the real question. QQQ's 136% 3-year gain is impressive, but you'll need serious guts to ride out those brutal 35% crashes along the way. Let's dig into the details. SPY delivered QQQ-like returns with half the wild swings. Perfect if you'd rather sleep soundly than ride tech's roller coaster nightly. In plain English, here's your road trip analogy. QQQ's the sports car with thrilling acceleration, getting you there faster, while SPY is the reliable sedan arriving safely with way less drama along the way. Now let's put this in perspective. QQQ's built for aggressive growth over 10 years, while SPY offers balanced returns for moderate investors with shorter horizons. In plain English, QQQ's the high wire act. Thrilling when you nail it, but one slip and you're falling hard. SPY's your safety net. Wider, steadier, closer to solid ground. Pick your tightrope wisely. Here's the thing, though. This disclaimer covers your behind. But your investment decisions, that's all on you, friend. But wait, there's more to the story. If you're hungry for more weekly breakdowns like this, hit that subscribe button now. I'll keep these data-driven dives coming.